So 2020 has been a roller coaster ride. We've seen a tectonic shift in market sentiment and investment behavior. And also the markets have had a lot to combat with. The US market swiftly declined in March. And in the same month, India's volatility index also went above 80. So clearly 2020 has been an outlier. We've also been seeing negative oil prices and gold run up. And also central banks have been announcing fiscal stimulus packages, and IMF has also declared it to be a global recession. So has the tide turned in 2020?
I think if we take a close look at what's happened in the market over the last few years, we noticed that the sentiment actually shifted in 2018 because that was also the year in which long-term capital gains for equity was reintroduced. But I don't think this was the reason for the change in sentiment. You were cooling off from the 2017 bull run. And over the last couple of years, what we've seen is just a handful of concentrated large cap stocks really performing and the broader market going through a lot of pain. So, a few events happened in 2018 and 19. So, in 2018, you had the NBFC crisis. In 2019, we were seeing lower growth projections. And I think COVID is basically just the last nail on that coffin.
Right. So I think probably earlier in January, right, given that there has been no historic precedence to this entire issue that we are facing today globally. So in January, there were obviously a divergence of views and how we should be handling this. And somewhere later in March, when it started becoming more relevant in India, there was some kind of consensus that was formed. And given that there's no historic precedence to how this global pandemic has to be handled, and we went into the lockdown and the market still continued to function. And now with the lockdown slowly being released in phases, we are seeing people adapting to some kind of a new normal also. And everybody is still trying to make sense of where the economy is headed, how long is it going to take to recover, and what is going to happen next. So, is the worst over or is it yet to come?
So, I like the word that you used here, which is unprecedented. None of us have been in this situation, and most of the projections that we're making today are contingent on assumptions. The market is so dynamic that these assumptions are also changing more frequently. So, none of us can be 100% confident that the worst is over or that it's only going to be good going forward, right? That being said, um, for India, we have two things to deal with. One is we have to deal with the problems that have come because of COVID. So that is having lack of economic productivity for a few months because of lockdown. And then we also have to combat our older issues which came in 2018 and 19.
Right.
So unless all of this is resolved, it's not a rosy picture for us yet. Right? But it's not also all gloom and doom. We have seen the government as well as the RBI come forward with some very concrete actions. So there was a lot of noise about how the government's fiscal stimulus package is only optically at 10%, but if you actually do the math, it's closer to 1% of GDP. But the clear message, which is quite positive from an economic growth perspective, is that the government is not handing out money for people to spend and revive consumption and therefore revive growth. What they're trying to do is they're trying to make people more accountable, and they're saying that you will get money through a banking channel, and that means you have to repay that money. So whatever you're using this money for, it needs to be productive, and that's how they're going to revive growth. Similarly, what the RBI has done, there have been a few measures that have come in. So cumulatively, they've reduced the repo rate by 1.15% in 2020. So this gives relief to borrowers and people who want to start something. And they've also introduced loan moratoriums. So keeping in mind that some of us have lost jobs or are dealing with reduced pay. So there's a breather for borrowers. And another thing that the RBI is focusing quite seriously on is monetary transmission. So this is making sure that those rate cuts that they're doing are actually reaching end users. The way forward in terms of economic recovery hinges on banks lending more. And also, one thing that we need to keep in mind is that the metrics that we've used in the past are not as meaningful today. right? Because the world itself has changed so much. But let's take a look at GDP. If we look at how India's GDP is sort of structured, you have the agricultural sector, you have services, and you have manufacturing. So agriculture has been a bit of a drag in the last few years, but surprisingly, through all of this COVID trauma, it has shown a sense of resilience. And what is also going to add to productivity in agriculture is the fact that there's a reverse migration. So previously, people were moving out of villages and towns into cities so that they could have more gainful employment. Now that trend is reversing, right? Then you have the services sector, which has actually taken quite a bit of a hit. But you're seeing a lot of innovation come there. So if you take a look at restaurants, the way that they're looking at profit sharing models, etc., that shows that there is some sort of innovation that's going into redesigning business models, and the rest of the industry also is going to come up with its own solutions. Manufacturing is the one segment that is going to take some more time to get back on its feet, because basically this reverse migration that has happened means that manufacturing companies need to set up or reopen their units and then find labor or skill them or reskill or upskill them, right? So that's a lot of work that has to go into preparation even before you can become productive. Uh, and I think in the next 1 or 2 years, you're going to see a positive change, and there is still hope for investors. Now, Rashmika, one thing that you had mentioned earlier was that there was a very steep correction in the market this year. Do you think this is the time to sort of buy the dip, or should investors just wait it out?
That's actually a very interesting question. But I would say there are a few steps we need to first do before we answer that question. So, something that an investor can do today is first review and take stock of what he's already done in the last couple of years and see where he stands as of today. The next thing would be to review his cash flows and his contingencies, because some of us might have reduced cash flows. Some of us might actually have unlocked a potential of saving more because we're spending much less. And also, it's important to keep aside some amount of money right now for contingencies because of the uncertainty that is there. So, first would be to do these two. And then probably it would be prudent if we set aside those additional savings or whatever little bit we can save here and there to keep aside for investing. And how to go about doing this investing would be in a phased manner. So if you're already doing an SIP, probably you can think about adding a little bit more to the SIP, or doing the systematic transfer plan where you're channelizing your lump sums in a phased manner, or even keeping something for investing 2-3 months later, because we don't know what opportunities are going to get unlocked in the coming days, or like how we are headed, how long we might take for recovery and things like that. And also to look at your asset allocation. So to see how much of your money is exposed to equity, how much of money is exposed to gold, how much do you have in debt and real estate and so on, and see how you are looking in an overall picture.
Right. I think this concept of asset allocation is very interesting, because usually people who have long-term goals would look predominantly only at equity, right?
Right.
And if we had someone who started investments, say in 2017, then that typical thing of I've been invested for 3 years is done and dusted with. But 3-year returns don't look great. Even 5-year returns, for that matter, don't seem very attractive, right? Whereas if they had managed to diversify a little bit here into, say, debt in 2018 or gold even in 2019, they would be seeing a much more holistic sort of return than if they had like a pure equity perspective. And I think this is also because people who invested in equity in 2017 have basically come in at the peak of a bull market, which means naturally you need to lengthen that sort of investment horizon, right? And another trend that we've noticed is that those investors who started or who basically restructured their portfolio closer to 2016-17 have a very strong small and mid cap bias, right? And this segment went through pain in 2018 post the bull run, and that pain was more pronounced in 2019 as economic growth was slowing down. And this year, there is a question of survivability. And the best case for an investor is that they just have an opportunity cost, which means their investments don't do much for a while, but eventually they sort of pick up and they recover. But the worst case is that they could actually lose capital because these companies don't survive. And the very fact that we are in a very challenging economic environment brings this question of survivability: which industries, which companies are really going to be able to handle the stress that's being put on them. So only the best are really going to make it through. And given that the investment landscape has changed so much, it would really make sense to take a hard look at what needs to change now.
Correct. So I think a lot has also changed from a human behavior standpoint. So I think first would be the risk-taking capacity that all of us have today, right? Probably somebody might have perceived themselves as a very aggressive investor when they started off in 16, 17. But today they might actually be facing it where their portfolios could have dropped significantly, or all other uncertainties that are happening now, for them to actually live through what they had imagined before. So the risk mindset has changed a lot. Secondly, I think people have become very conscious about having emergency funds, contingency money, and not spending it on discretionary expenses. So they've become a lot more conscious and aware that they need to keep aside something for a rainy day. And third thing, I think they've become a lot more mindful about what they're spending on, because I think some people have seen how much their potential to save is because they've not spent on anything discretionary in the last couple of months, and they are like segmenting whether this is absolute essential to be spending money on. So this is what has happened across in the last few years. But however, even though people might want to act on their portfolios, they've always been a little hesitant. So their portfolios have kind of remained similar over the last few years, where they've not made, I would say, aggressive calls or like actionables on the portfolio. So there are a few things that if an investor does now, it is going to take them a long way. So the first thing, like we covered before, would be to do an investment review, like reassess what their risk mindset is, whether they have set aside enough amount of money for contingencies. And the next one would be to also realign your expectations. Like you correctly said, the 3 to 5 year cycle for somebody who might have started investing in 16, 17, they're somewhere closer to that. But because of this, they have to realign as to how their expectations from a return standpoint, from how long it is going to take, time taken to turn around for the recovery and the growth. And third would also be to manage the risk that they are exposed to on their portfolio, and get an opinion and advice on, whether if there are like bad ideas in the portfolio which are going to take much longer to recover, how they should be approaching that, or if they should be adding something to the good ideas that they might already be holding in the portfolio right now, so that it will help them in the recovery faster. So making those choices and course corrections now could actually set them up for the upcoming market cycle, and understand how they'll be headed and how that will make a difference to the portfolio. But then again, I feel that everybody has like their opinion. They might be reading so many things on the internet and be exposed to so much information that they're actually confused about how they should course correct their portfolio. So this comes to the important question where, in the current scenario, whether they should actually reach out for professional help, pay for advice that they are getting.
I think all of us know that there is no free lunch, right? And with free advice, the the problem is that the person who is receiving the advice really pays for the cost.
Correct.
And this is because whoever is sending out advice has no accountability, and they don't really understand who the end user is. So I may not know what that particular person's needs or risk appetite or anything is, but I'm just giving a general opinion, and it may or it may not fit, right? And because there's no accountability, there's also limited action that someone can take from the advice that they see on the internet. And there'll be so many divergent views that you don't really know which ones are valid and which ones are not. And even sort of setting a quality filter for free advice is much harder.
Yeah.
Right? Whereas what an investor can focus on right now is to look at accountability. So one way to know that you're definitely in a system where there is accountability is to opt for a SEBI registered investment advisor, because you know that they are regulated by SEBI. You know that there are certain standards of advice that they need to adhere to, and what really is the need of an hour is for someone to have a continuous engagement with an advisor through this market, because we've talked about how dynamic it is, how much assumptions have changed, how much uncertainty there is. So advice that is given today is not necessarily going to be the same as advice that's given 6 months down the line, because we don't have that much of space to really talk about finances or the kind of decisions that we are making in our personal lives, right? Whereas, like, if you have a professional engagement, that you create that space and you create that environment to have the kind of conversations that you need to have. And this is why I think, firstly, hiring a professional makes sense. But let's get back to the question of cost, right? Because I can completely understand where investors are coming from in this market. You're already dealing with a situation of, say, uncertainty in terms of your job or cash flow. So an additional expense is really not something that anybody would want to look at, right? But I think that good advice is worth its weight in gold, because if you get even one of those investment decisions executed on time, then that is going to pay for itself. Of course, you're going to pay upfront, but your rewards are going to come over a period of time. Absolutely. But it's definitely paying back for itself, and it's totally worth it if you do your quality filters and you get it right. But how do you know that you're selecting the right advisor? I think there are a few ways that you could go about doing this. One is to look at your network and see if somebody that you know and trust is working with an advisor, and ask them for an honest opinion, right? So this would work like a referral, where you're asking somebody what they think, and based on their opinions, you can do your own research and sort of finalize on what works for you. Luckily, we live in the day and age of internet. So in case you don't want to approach someone in your network, or you have certain reservations about working with a common advisor, the other thing that you could do is actually look for advisors online, try to see what kind of reviews they have, do some research on the kind of experience and the people who are running a particular organization. And then once you've established a certain level of comfort, identify the kind of service that you're looking for and see if that advisor is willing to provide it for you. And I think surely that is going to have a positive impact on your wealth creation.
Absolutely.
So what makes the ithought investment review different? We start by understanding your risk profile and reviewing your risk tolerance. This helps us suggest investments that you can stay invested with in the long run. We personalize advice on your holding so that you get advice that's relevant to your needs. We also evaluate the quality of your investments. We know that a quality company is going to survive tough times, and this will work towards preserving your capital. We also assess investments based on their future performance potential, and we go beyond ratings and past performance so that your investments can serve you for a brighter future. We follow an asset allocation model. This ensures that your investments work through every part of the market cycle. We help you restructure your portfolio and remap your investments so that they cater to your needs. You also get to have one-on-one meetings with our advisors to discuss exactly what you're looking for and to resolve any issues that you might have. We have a continuous engagement process where you can get back in touch once you've implemented actions to know what you need to be doing next. Why should you choose us? We've done nearly 130 reviews in the last 1 year, and we make merit-based decisions. So this means if we see value in what you're already holding, we're going to tell you that you can continue holding that. And if we see risks in what you're holding, we're going to highlight those to you as well. We have a focused team of researchers and strategists who study in detail the portfolios of fund managers as well as individual securities like stocks or bonds, and then throw up a recommendation which is suitable to your profile. And of course, the added advantage is that once your report is ready, you also get to meet with us one on one, and you get to understand what your next steps are. And this will ensure that you have a smoother journey in wealth creation. Thank you.